Hello, I'm Hickey from interest.co.nz and welcome to a special report from here at the Reserve Bank in Wellington, where the Reserve Bank has just released its half-yearly financial stability report, in which it says that our banking system is strong, and in fact stronger than it was 6 months ago. Funding costs have fallen for the wholesale debt that our banks have offshore, and financial market conditions are a bit stronger because of so much new monetary policy easing around the world. However, the Reserve Bank has warned that it's watching banks lending into the household sector. It says that it is concerned that there could be excessive credit growth in household lending. House prices are up around 5% in Christchurch and around 10% in Auckland. And the Reserve Bank reports it's hearing from the banks that they're doing a lot more high loan-to-value ratio lending, a sort of 80%, 90% high loan-to-value ratio lending. The Reserve Bank also reports that credit standards have eased, particularly in household lending, not so much in small business lending. The Reserve Bank has also highlighted the huge amount of dairy debt that's out there. It pointed out that dairy debt had pretty much doubled from about 11 billion to 22 billion between 2003 and 2008 as the dairy payout increased and dairy land prices increased. The Reserve Bank says that the intense amount of stress that some of the more leveraged dairy farmers are facing has actually increased in recent years, and that it's more vulnerable than it was just before the crisis in 2007-2008. Just to give you a sense of how big the dairy debt is, it's about 10% of all lending in New Zealand and about 63% of all farm debt. The Reserve Bank has done some analysis on the dairy sector with Dairy NZ and found that 64% of the dairy debt is held by farms that would be making losses if the payout fell to $5. It's around about $5.70, the current forecast. And it says that if the payout were to fall to $5, that about 22% of the debt would be held by farmers who are making losses and who had loan-to-value ratios of greater than 80%. And to give you an idea how much more stress that is, that's 22% who would be in deep trouble if the payout fell to 5%, compared to 7% who would have been in deep trouble when it did actually fall to 5% in 2007-2008. So a warning there from the Reserve Bank about excessive credit growth, the potential for it in household lending, and also high levels of debt in the dairy sector. But what is the Reserve Bank actually going to do about it? Well, we spoke to Graham Wheeler in his first press conference as Reserve Bank Governor after the release of the Financial Stability Report, and we quizzed him in particular on loan-to-value ratio limits. Remember, the Bank of Israel and the Canadian authorities have imposed loan-to-value ratio limits in recent months to try and cool down their housing market. Everyone's got this problem where they want to cut interest rates to boost the economy, but when they do that, they pump up asset values and their housing markets at the same time. New Zealand, in a way, has that same problem. Record low interest rates, but a housing market growing quite strongly, particularly in Auckland and Christchurch, in part because of housing supply issues. So we wanted to know, would the Reserve Bank go ahead and impose loan-to-value ratio limits to give it more flexibility on monetary policy? And the word from the Reserve Bank Governor was pretty tentative. He said that the Reserve Bank is looking at it, but that even if it had these loan-to-value ratio limits at the moment, it wouldn't actually use them. So the Reserve Bank's new Reserve Bank Governor seems pretty keen to take a hands-off approach on the housing market and on intervening in not just the currency, but also in the area of loan-to-value ratio limits. So there we have it, a special report from here at the Reserve Bank in Wellington on the release of the Financial Stability Report. I'm Hickey for interest.co.nz.